Welcome and thank you for joining this Centurion Apartment REIT Advisor Zoom webinar with Greg Romundt, President and CEO of Centurion Asset Management. My name is Paul Mayer, Head of Sales, and I will serve as moderator for this webinar, which should last around 30 minutes. Given the large number of participants, all participants have been placed on listen only. I should like to also mention, as I mentioned before, that this webinar is being recorded and will be available on our website in about a day or so. The Centurion Apartment REIT now has over $5.3 billion AUM with an annualized rate of return since 2009 inception of over 13% a year. The REIT is Canada's largest private apartment REIT and its second largest apartment REIT, public or private. Well, Greg, thank you so much for your participation in this webinar. And let's begin, if you have some nice brief highlights of 2021 as it relates to the REIT.
2021 is a very active and successful year for the REIT, despite the ongoing COVID-19 challenges and the impact on the economy. The trust once again proved to be resilient to these negative headwinds, Consolidated assets increased by 23% to $4.1 billion by the end of 2021, but today, in fact, we're about $5.5 billion. In 2021, net income and comprehensive income increased 117% to $247 million. The Class A and Class F returns were 11.27 and 11.9 respectively. To May 1, just last week, returns were approximately 18% year over year after the recent NAV bump. So, pretty great for a period of still great uncertainty in the market. Acquisition pipeline was very strong in 2021 and it continues to be so. We've acquired or created 18 investment properties, which further expanded our presence across Canada. Same-store total operating revenue increased about 1.9% as the trust diligently worked to lease up and stabilize a significant number of properties added to the portfolio during the year. So we think this really understates where we are, where we're headed. Portfolio occupancy on stabilized properties is about 93%, while unstabilized properties, including lease up, had an occupancy rate of about 87%. The same-store NOI margin decreased slightly to 64.9 in 2021 from 66.4 in 2020. The minor decrease in same-store NOI margin and in the occupancy was a result of the short-term increase in vacancy in the student housing portfolio in the 2020-2021 year, which still fell into the 2021 results. And but those student housing occupancy rates are back up to around 99%. So, I think this is the look back is not anywhere near what the look forward looks to. Vacancy rates at the student properties are, as I said, back to basically normal. Same-store apartment and same-store average rents were increased by 3.2% in the apartment portfolio and 6.2% in the student portfolation. Again, the apartment portfolio probably reflects a little bit light on where it was since last year we also had in a number of provinces the rent freezes in place. So I think we'll start to see that pick up into the new year. The largest increase in average rent per unit was this 6.4% in the stabilized Canadian apartment portfolio, which really still, again, somewhat understates, given that that number includes a number of provinces where the rate increase was zero because of COVID restrictions. So we're very honored to be named as a successful recipient of numerous awards in 2021 that recognized our positive workplace culture. It's a large focus here, including being listed as one of the best workplaces in Canada. In addition to this, Great Places to Work is also named us as one of the best workplaces for women in Canada and one of the best workplaces for hybrid work. As we've always said for the last 2 years, the world is not going to return to business as usual, and hybrid work is basically the future. So we need to be ready for that. That's been a focus of ours. So we've also currently been shortlisted in 3 categories of Wealth Professional Awards to be held in June: the Alternative Investment Solutions Provider of the Year, CEO of the Year, and Employer of Choice. There you go.
Well, those are truly great accomplishments, and congratulations to you and the firm, and fingers crossed for the awards for the June 1st Wealth Professional Awards. I guess now let's turn to 2022, and I was wondering if you could provide us a little bit of an outlook for the REIT for this coming year.
Sure. So we're off to a pretty strong start in 2022. We had the recent closing of a $1 billion 30 building portfolio in and around the Montreal, which had 3,677 rental units. In addition, we closed on a building in Surrey with about 233 units. And we've got a number of acquisitions slated for the rest of the year. So about another 700 or 800 million in announced acquisitions or planned acquisitions if we didn't do anything further in the rest of the year. While the 2022 acquisition pipeline is robust with many exciting opportunities to acquire modern, recently constructed investment properties with low capital investment needs, the property market is pretty tight here. So that still said, we still prefer Canada over the United States, as we're finding the US to be particularly expensive. In fact, we did take advantage of a strong US apartment rental market to sell 3 properties in the last year. In one case, a building which we had valued at 57 million US, we sold for 78 million just 5 months later. So, that's, that is a very unique position. So we're not normally sellers generally. I mean, historically we've sold almost nothing, but sometimes values are so compelling that you have to do something about it. And, if we no longer see value in a property at the price that it's worth, then we'll often, the next logical question is, should we keep it at all? Here in Canada, I do like Quebec because it's a very active market and Canada's largest rental market. It is also relatively cheap compared to the Ontario market, which is very competitive because of limited supply, and development goes traditionally or most often into the construction of condominiums, because that's a higher profit margin sector. So it's very difficult to compete for apartments to be able to pay the same price for the land that can be developed into condos at much greater profit levels. So governments are now permitting apartment landlords to raise rents again. So we expect to catch up to market rents over the time, even with lower turnover. Fastest rent growth in the country is in the West. These real estate markets are really on fire. The fortunes of Calgary and Edmonton should grow with the current commodity boom, and people are moving to Alberta. It's seeing net immigration because it's very affordable to live and offers a great outdoor lifestyle. And as we've talked about as a theme for the last 2 years, people are moving to communities where they can get that combination of affordability and lifestyle considerations, and work from home is enabling that. However, that said, it's hard for us to double down on Alberta so long as there's a Liberal government in power intent on suppressing the oil and gas industry. Centurion would be certainly much more active in Alberta if there was a party that saw the solution that Canadian oil and gas could provide to a world that is currently forced to buy from despots. Examples of rent growth in certain cities: Toronto suburbs, which are seeing rent increases between 6 and 10%. And our portfolio, Surrey and Kelowna, and these kind of markets, we're seeing over 10%. Cambridge, about 5%. Kitchener, about 3%. Nova Scotia, about 3.5%. And Kelowna is where we're seeing the strongest rent growth, 20%. Again, I believe because it's in that commutable distance of in that, prosperity bound around Vancouver. It is also much cheaper and gives you a great lifestyle lifestyle considerations. So we just think these kind of cities, it's not just limited to Kelowna, it's everywhere in the suburban and exurban areas in Canada, I think are going to continue to benefit.
Now, Greg, though, you did mention that there's a lot of active, robust institutional buying, and you gave some great examples about rent increases. However, will Centurion get affected by what we're hearing, increased government regulations of REITs in general?
Well, I've gotten this question a lot. I just like to point out that I think the target of these government interests is the real estate investment trust that own homes. Not necessarily apartments. The target really is a Canadian REIT and some other organizations that are out trying to roll up and buy single family homes, like has been happening for a few years in the United States with quite a bit of controversy. And I recall when this strategy first got announced in Canada that I had suggested that governments would not be very favorable to that because they really don't want billion-dollar corporations competing against mom and pop to buy their first home. That's not what we did, right? So when we buy a 100-unit apartment building, this has no negative impact on people's ability to buy homes. In fact, Canada needs a massive amount of housing, both purpose-built ownership and purpose-built rental. It's been estimated that we're currently short about 1.9 million homes in Canada. And if we have immigration targets, which are today around 450,000 per year, that means 4.5 million over 10 years, which means we're going to need about another 2 million homes on top of the shortage we already have, give or take. So if we need 4 million homes and each of these costs 500,000, that's about $2 trillion of capital required. And even if we as a country can build all these homes, which we can't, I just don't see it as possible that we have the labor or the infrastructure to be able to get that amount of housing completed. So if 40% of this 2 trillion of capital required to go into housing is going to go towards purpose rental, that's about $800 billion of capital required just over the next 10 years to catch up to where we need to be and to accommodate the incoming immigration. This is an order of magnitude larger than the existing size of the entire Canadian apartment REIT sector. It will be impossible to build that amount of housing without institutional capital, no matter how it's construed, whether it's life insurance companies, pension funds, or REITs. Without it, it just can't be done. You can't build $100 million buildings with 6 dentists getting together to trying to do it in a joint venture. It's just never going to happen. So while this doesn't mean that governments don't make mistakes or virtually signal their way to the next election, which we can be assured that they will most certainly would know that if they make it harder than it already is, and it is exceptionally difficult to build apartments or any kind of housing in Canada due to the rules and 3 tiers of government you have to deal with, then it's just not going to happen. So I believe the housing market shortage is so dire that there's no alternative to actively incentivize the construction of apartments and not to tax it to death. Does it mean it won't happen or can't happen? I'm not saying that. Like I said, governments don't do things that are necessarily in the long-term best interest of the country. They do what's in their personal best interest. That said, as an inflationary environment, as I will discuss later on, the apartment sector, as does the rest of the economy, runs the risk of being subject to price controls, just like those that existed in the 70s and 80s and the last time inflation was where it is today. While this is not desired, the Canadian apartment industry has had 50 years of experience of learning and adapting to rent controls to the benefit of investors and tenants. So to reassure, I'm familiar, with the projects that CMHC is working on, and I ultimately believe that they will design an infrastructure that's going to result in many more apartments being built and not restricting the space unduly. It's certainly my view that that's what the governments want. It's what CMHC is trying to encourage. So I'll reiterate that I believe that we will build as a country more apartments in the next 10 years than we have built in 2 generations. So I stand by that belief.
No, it's certainly very, it's almost awe-inspiring concept of what we have to get our heads around. I'd just like to interject at this point in time that this may be one of those podcasts that broke the internet, insofar as you may be experiencing a little bit of internet disconnection from time to time. That's as a result of how many people are actually trying to get onto this webinar. So I would encourage everybody, though, to stick with this internet connection, even if it may be a little bit wonky from time to time, because I can assure you the next 20 minutes of what Greg is going to discuss is definitely worth staying around for and being patient. I would also like to remind you that we will have a very clean copy of this particular webinar for your listening and viewing pleasure in about a day. So don't worry if there's you missed a couple of things through the internet misconnection. We'll have a clean copy for you that you can watch again and send also to your clients. But let me now go back to another question, which is, you talked about this massive need for multi-residential apartment buildings in Canada. Does that need necessarily translate into other Canadian real estate subsectors?
Maybe for university housing, as Canada is still a world destination and seeking to be a world destination for overseas university students, and our ability to build supply is incredibly slow and onerous, but I can't say there's a compelling segment for any other subsector. I mean, the talking heads in the office market continue to talk their own books that the office market will return to normal. It's just not. Here we are in year 3, and I'm still doing virtual tours because we haven't been in an office into, now is what is year 3. I've been saying this for 2 years. Like, vacancies are already at a 27-year high and likely to continue to drive higher. The shift to remote work, flexible work, hybrid work, whatever you want to call it, will permanently downshift office demand. Some companies will choose to be 100% virtual. Others a combination of virtual or in person. Very few, if any, will return to 100% in office, except in maybe some limited sectors. Surveys today that we get suggest that if we were to ask employees to go back to the office for more than 1 day a week, or maybe 2, we'd have a mass resignation event. And market surveys suggest the same across other sectors and other companies as well. So I just don't see any prospect that we're going back to normal for a really long period of time. So the only question is how long this impact is going to be and how long it's going to play out. Investor demand will be for apartments and warehouses, logistics, real estate, as much of our economy will try to be online. But I just don't see office and retail recovering any way that some have suggested it would, at least for a long time. I also believe that seniors facilities will face a storm of problems, and that this industry will never really be the same. I wrote about this 2 years ago. With the vast majority of COVID deaths being in seniors facilities, these facilities have significant problems attracting residents, as they will be seen as the absolute last resort for those without options. Families that were unable to see or assist parents and grandparents in lockdown will look at moving family members back home if they haven't already done so, if it is at all possible. In other words, if care is possible at home, people will do it at home. And here we are today, and boomers, you've seen articles recently, boomers are being blamed for house prices going through the stratosphere because this normal cycle of people's children moving out, they age until their mid-60s or whatever it is, 70s, and then they sell their home, which makes it available for someone else to buy. And for them to move into seniors' homes, that cycle's been broken. I mean, they don't want to sell because they don't want feel like being dutifully locked up and isolated in a prison like death tramps, otherwise called seniors housing, and prefer to age in their own homes. And I expect that that's a trend. That's what I wrote about 2 years ago, and I believe it will continue to be the case for a very long period of time.
And then how would you characterize the properties of the Centurion Apartment REIT, just generally?
Yeah. I think almost everything we're building or buying is what I call affordable, middle class housing. Even the stuff we technically call luxury isn't really in the context of what luxury pricing is, right? So, but it's new and it's high quality compared to what the residents may otherwise be looking for or is otherwise available in the market. We do have some subsidized housing or lower cost housing from various programs in the country, but not a lot of it. Not a lot of the programs make any sense at all. So they talk about these programs that they have for building housing. Some work, some don't. When they do, we look at them. Most often it's a break on property taxes or development charges in return for below market rents or for a period of time. So these programs are all just math, right? So they either work or they don't. But I find it puzzling that in places where we want to build, like Toronto, which is desperately short and attracts most of the new immigrants into the country, Toronto's proposed increasing development charges by 40%. So that's not helping affordability at all, because the only people that actually pay for that are going to be either renters or buyers of those units. So affordability is getting worse, not better.
That's amazing. That's amazing, actually. Maybe that was actually a nice little segue into the mortgage book of the REIT. You have a few words regarding that?
Yeah, sure. I mean, the mortgage book of the REIT has shrunk as a percentage of the total portfolio because of the growth of recent acquisitions. And some of the monies that we've had in the fund have been used on those acquisitions to build liquidity provisions, and the marketplace is becoming competitive, so it's harder to win deals to fund. But this is exactly what I've said would happen over the course of 8 years, which is the mortgage book would rise as a percentage and then decline as a percentage, not because the absolute dollar size shrink, but because the properties that we're going to get out of that program are come onto balance sheet and stay, as opposed to the mortgage book would spin and spins. So the last little bit is very, very much business as usual. The deal team is active on the traditional apartment areas, condo and student residence development lending. We're fairly restrained on condos today, because one of the real concerns that I have about the condo market is, aside from the absolute price levels, that inflationary cost pressures are rising so quickly that one of the challenges is in order to get bank financing on a condominium, and we're usually either partners with a bank or subordinate to a bank as part of the capital stack. If you have to, and the banks will require like 70 to 80% pre-sales before they'll agree to fund. So if you're doing your pre-sales now for 3 years delivery, virtually impossible to lock in your costs. Very, very few contractors are willing to lock costs when, in some sectors they've risen by 25% in the last year, right? So, and even if they do, you really, in most cases, can't believe it's not worth the paper it's written on, because a contractor would face bankruptcy if they honored that price and it cost them 25% more or 50% more to deliver on the product. So I think this is going to be a real challenge for the condo industry, not just us to overcome, is these periods of high inflation will destroy the ability of the housing market to deliver product at all. It's going to be challenging.
Wow. Well, before we turn now to the macroeconomic landscape, how are you negotiating the yield curve? We can use that as almost like an introduction to inflation.
Well, for some reason I'll explain later. I still believe interest rates can only go so far, as the entire global financial system is over leveraged and really has some great challenges. So the central banks will have no choice but to inflate their way out of this inflationary mess. And there is no way that interest rates can be raised without crippling the global economy. The fact is the vast majority of our mortgages are long-term. Weighted average maturity is around 6 years. Weighted average interest rate, call it 2.6%, give or take. The yield curve is in the US certainly has been recently inverted, which suggests that they're going to hike rates for 2 years and then promptly cut it as soon as they break something, which it seems to be based on what's happening in the market, exactly what they want, exactly what's happening. I think the mortgage investment portfolio earns considerable income from just pure interest point of view. And so we could use these proceeds anyway to cover increased mortgage costs, even though I really don't expect that interest rates can go much higher. Remember, when I look at 2-year interest rates, 2-year interest rates and 10-year interest rates have already priced in the increase in the short term, right? Because you have an upward sloping curve out to 2 years and then downward sloping after that. So yeah.
Wow. Well, I mean, that sets the stage now, for the discussion of the macroeconomic landscape. So first of all, which is a big chunk, what are your general thoughts about inflation? Because this is what dominates all discussion right now, but I know your insights are particularly insightful.
So to put my thoughts into context, many may recall my August 2020 report where I published, it was called Regime Change Ahead, Why I've Changed My Core Thesis from Disinflation to Stagflation, basically called the turning point near exactly on inflation and what was coming. Nearly almost 2 years later now, supply chains still aren't fixed. And as I said at the time, we won't be due to deglobalization and hostility to China, which I should now say includes Russia. This paper, I remind you, followed a 10-year period where I said that disinflation and low interest rates had been my core thesis, where they would go, eventually to zero and then negative, and they persist way longer than anyone dreamed conceivable. People called me nuts. I've said this many times. As I said, rates would go negative, but one by one, this happened all around the world. It wasn't very long ago, we had stock of what I think was 16 or 18 trillion dollars in global bonds were negative yielding. So this combination of ultra low interest rates, quantitative easing, and massive government fiscal spending laid the massive inflationary tinder, which now following those factors have sparked, deglobalization is happening. It has to, because it's just too risky to have enemies make what you need to live, like China for basically everything, and Russia for gas, for energy supplies for Europe and commodities. Globalization led to 30 years of disinflationary trends, and that was enabled by the peace dividend when the USSR fell apart. If we did not have the peace dividend, we probably wouldn't have had the same benefits of globalization that we did. So disentangling what took 30 to 40 years to happen into a 10-year time frame, because it's geopolitically strategic requirement, and it's going to hurt to do it. So you think about you taking a car driving 60 miles an hour and you try to put it back to where you started in a third of the time, and you're going to have a life-threatening injuries trying to do that. So, then we add on the Great Resignation has certainly led to supply shortages and wage inflation, compounded by work from home, which has allowed labor so far to auction themselves to anywhere they want for their skill base, without actually having to leave their living room. Part of this was also a number of roles or jobs that people are no longer willing to do because they were either economically precarious in the first place. So think about bartenders who didn't have steady jobs for 2 years, deciding, I don't want to do that anymore. And certainly if I'm going to, not at that price. So these are inflationary. It's not transitional. It is inflationary. Vaccine mandates, as I said 2 years ago, were stupid and dangerous because in a fragile supply system with a shortage of workers, these mandates make things way worse. And you want to look straight at China, which is still trying to pursue into year 3 a zero COVID scenario. And if you want to see this in a very visual way, do a lookup of ships parked in the port of Shanghai, and you'll just see more boats than you'll see actually water. It's pretty fascinating. So these lockdowns that never end change people's ideas towards work, and severely weaken small businesses and crush their ability to both earn a living and attract staff to stay afloat and to rebuild into the future. So here we are, year 3, and we're still working from home and no one wants to return. So all of this was really conspired to ignite the massive inflation we're experiencing today. When I published my regime change article, the Bloomberg Commodity Index was 70, and today it's 125, up around 80% in almost a straight line. It's one of my best market calls in my career, so I'm very proud of that. But obviously, I had no insight that we'd now be facing a war with Russia. But all the ingredients of this fourth turning suggest that there would be fireworks, and this is just one manifestation of that. So, I mean, I think for people who are looking for explanations on what's going on, this is an excellent book I'd recommend. It's The Fourth Turning by Howe and Strauss. Excellent book. Talks about the cycles of history and how these things play out. So that's been very influential on my market calls and my positioning. Today's inflation and energy shock from the Russia-Ukraine war is as bad as the 1970s, but the inflation we're seeing isn't the true picture because the CPI indices we have today are so manipulated with hedonics as to not be comparable at all, and using the same measurement methodology as we did in the 1970s suggests today's inflation is actually worse than it was back then. So I firmly believe inflation is, and will continue to be non-transitory. Worse for those unprepared, we see nothing yet. Energy and commodities price spikes really aren't fully reflected in the data and soon will be. And inflation expectations will increasingly get anchored at these higher levels, which then makes inflation self-perpetuating, which requires a strong monetary policy response. So one of the ways to see this is if you look at the futures curves for a lot of commodities, they're in backwardation, which means, so oil for delivery now is $110 a barrel, but 3 years out is $70 a barrel. So, it suggests that the market believes that these prices are going to convert or revert. So in part, this prices into other markets, right? Inflation expectations, interest rates, stock markets, et cetera. And if these price disruptions are non-transitory, which is my core thesis, then we're going to see these expectations start to flow through in all other segments of the market. So.
But we're seeing now strong monetary responses, whether it's QT or interest rate hikes. So are we not entering into a new phase, as I mentioned, of interest rate hikes and QT, which will actually stem inflation?
Not at all. So it's all a head fake. There's no chance they can arrest this inflation by increasing rates in smaller increments. Like if you think that real interest rates have to be 2% and inflation's 8%, you need 10% interest rate to nominally restrain inflation. So if you look at the best correlate of inflation, like inflation indicator or what an interest rate should be, Fed funds rate, you look at the Taylor rule. And the Taylor rule says that in order to have non-accelerating inflation, Fed funds should, instead of being around 1, we should be around 11.5. So we're 1,000 basis points short of the rate that we need to constrain inflation. There is no chance, like zero, that that happens, because they would blow absolutely everything, including the governments up and the banks. Everyone blows up. So I believe they will try, but they're going to panic when something breaks. Central banks always break something. This time will be no different. So they will hike some rates. There's no question about it, which will slow the economy if we're not already in recession. But inflation will still rip higher. It is too little and too late, and 25 or 50 basis points at a time will do nothing to halt official inflation running, 5 to 7, 8%. Let alone real inflation, which is running higher, not their fake CPI indices. Nothing. Politicians and central banks know this, and they're lying that they can fix inflation. They can't. Their central banks are trapped between the need to pump in liquidity to keep the system liquid. Inflation they can't control because, they can print money, but they can't print wheat to eat and oil to heat. So, the only thing that they've got left is to try and slow the economy by increasing interest rates enough. But I don't think that's going to work. Rates will be kept lower than inflation as financial repression to help governments eat away our savings to pay back their reckless spending. So the crack-up boom is now upon us. A crack-up boom is when asset prices will rise to the sky as the only protection from the ravages of inflation. But first, central banks have to scare stocks lower to put some fear into the markets and make it look like they're actually doing something, to show that the Fed is serious because their reputation is in tatters. An extreme example of a crack-up boom, you look at places like Venezuela, which saw, their stock market rise, 3 million times? But the real value was down 95% because of inflation and currency depreciation. So, it doesn't matter if the Dow goes to 300,000 if the value of your currency has eaten away all of that gain. In fact, it's worse because those gains are taxable. You lose virtually everything, even if the asset prices keep up with inflation. And you lose money in real after-tax terms. So, in a crack-up boom, really the only things you can afford to own are real assets.
So then, with all this being said, where are we now? Like, how does the macroeconomic landscape look to you at this very moment?
So, as I published in a recent paper, I previously argued in my regime change article that we were moving into a period of higher inflation and that deglobalization was going to be the driving force of this. Russia-Ukraine war has now accelerated this. Germany imports almost all of its energy from Russia, and Ukraine supplies large amounts of commodity products to the world, which is one reason driving commodities prices higher. What's worse, though, is that half the world's population, including China, are lining up behind Russia and defying the sanctions, choosing not to commit economic and political suicide by going along with the West. Because if the West chooses to ramp up sanctions on non-compliance with Western sanctions, then inflationary pressures will accelerate even further. So, I have very low confidence that even if Western governments know this, and they most certainly do, that they don't like to be defied. So I sense that they would do it even knowing the catastrophe this would have for world hunger and inflation and the economies even of the West. However, that said, deglobalization is completely at odds with the current rate hike cycle and the discussion around quantitative tightening. To re-onshore supply chains and to produce commodities and to rearm, basically a full reversal of the so-called peace dividend post the Soviet collapse, will require trillions of new spending. even Canada is now talking about being the miner of the world and talking about tax credits to the oil sands for carbon capture to release some of this previously dirty oil. I use that in air quotes because I don't believe that's the case. So has something really big happened? And I would argue yes. The West and much of the Western world must get on a war footing. Not because a physical war will necessarily happen, but because our perceptions of the possibility of war have changed. See, there's an old expression that if you want peace, prepare for war. And at no time in the last 60 years have we been at more risk of a global hot war. And in a war, you must be able to take care of your own citizens because, no one else, no other country will do it for you. And as we saw during COVID, every nation scrambled to secure its own supplies, everyone else be damned. And that was just a health crisis with, a disease where 99.8% of people survived it. So you can imagine where we're at physical arms, we're at the risk of it. So this kind of situation is by definition isolationist, and it's inflationary. You must have internally everything that you need as a country to feed and defend itself, which includes the security of your supply lines. So, when we think about the supply lines just in time that were enabled by deglobalization and the collapse of the Soviet Union and the peace dividend, which allowed that globalization, goes into reverse, then we can no longer have these supply chains which are distributed around the world. What COVID initially showed us was a very risky strategy. But post Russia and Ukraine show us that this is now not just a financial decision, it has national security implications. The West must shift to war footing to produce inside your borders everything that you need: food, energy, chips, weapons. This will require trillions of dollars in capital. That's just in Canada. So the numbers go up an order of magnitude in the United States and you add in Europe and all that. So it is impossible, I'll repeat, impossible to do quantitative tightening and raising interest rates and slowing the economy if we must be on a war footing. That means sooner than later, we can expect strategic initiatives to do this and to bring money printing back on a grand scale beyond anything we've seen so far. Because in the big picture, inflation doesn't matter. As insensitive as that sounds, in comparison to national security. Look at Ukraine. I mean, I'm sure they would take a little bit of inflation to have a greater war infrastructure, right? So I think any nation or group of nations looking at this will choose national security over inflationary pressures. We have to remember that the closest correlate we had to this was in the 1940s, where we had high inflation as we fought World War II. Well, not we, but global West, global world. Rates were held low at around 2% to help finance the war effort. And, a lot of people don't remember, they think about the dual mandate of the Fed. So the mandate of the Fed at the time, they added a third one, and that was to cheaply finance the war effort. So here we are with massive debts. Raising them kills the economy at the very time that a massive spend on national infrastructure greater than at any time since World War II is required. Inflation will be allowed to rip higher for longer because it has to, given that the money required to make this shift. And while there will be fights over Build Back Better, as there are ideological differences over climate change, reshoring, and national security, will ultimately drown this out. I noticed that Greta Thunberg's pretty quiet recently, and that's because I think that the tone has shifted from the green movement towards we need to be ready. And you can see that, like there's a number of strategic initiatives that have been announced in Canada, but also in the United States about reshoring And, you know, there's numerous examples, you just have to keep your eyes open for it, that these things are, you know, building chip fabs, which cost billions of dollars in the United States. This is really big news because we haven't built a chip fab in the United States in decades, right? They're all guess where, in China's field of influence. So we have to be very careful of that. I'm not convinced that the market understands this yet, but it sets up some of the greatest macro trade opportunities to bet on inflation and on hard assets, of which apartment real estate in particular should be served fairly well. You know, I would invite everyone to download my latest white paper, which I expand on the above ideas and you know, bring in some additional supports for my newest updated thesis. You know, so you can try and think about how you recalibrate portfolios for this, you know, for these in the face of these historic economic and geopolitical challenges.
Wow, Greg, thank you so much. You've given us really a lot to think about and a lot to chew on. Well, that brings us to the end of this webinar. Greg, thank you again for all of your insights into the REIT, the multi-residential apartment sector here in Canada, and most importantly, how to navigate this new and challenging economic and geopolitical landscape. The discussion was truly insightful. And so on behalf of Greg, myself, and your wholesaling teams, I would like to thank everyone on this webinar for your time and most importantly, your continued support. It is truly greatly appreciated.
Oh, one more thing, Paul. One more
What's
thing
that?
before you wrap up. I did publish a new article today.
Oh, yes, that's right. I'm glad that you reminded me. Underpinning these discussions and these points that Greg raised is a lot of work, obviously, and we have published now 2 white papers, one of which has been on our website for a couple of days, and I believe another piece, a more technical piece in relation to interest rates and inflation and cap rates, has just been posted today or at latest for tomorrow morning.
Yep,
so I would invite everybody to access that. And what it will do is just trigger a robust discussion, we hope, in the industry as to how best position assets and portfolios in these very interesting times. And so I just wanted, again, take this opportunity on behalf of everyone at Centurion to thank you all for your wonderful support. We really do appreciate it. And I should like to highlight that the REIT is open. And so, you know, Greg can very effectively deploy any capital that he receives. And as you know, the REIT remains an excellent hedge and return driver in these inflationary times. So should anyone have any follow-up questions, please do not hesitate to contact myself or your wholesaling team.
Thank you, everyone.